Hi all, this is Rachel. I'm the Director of Mortgage Helper. Today, this video, we're going to explain about fixed term loan and variable loan. So I believe everybody will have a basic concept of what is a fixed term loan and what is a variable loan. Fixed term, it means like, you fix for a certain period, the repayment and then the interest rate will be the same. With variable, it means like it follows the market rate. If it goes up, it goes up. If it goes down, it goes down. So before we get into further detail, because variable will involve with offset account, and both fixed and variable will involve with repayment. So we'll start with repayment first for today. And pardon for my handwriting, I'll consider get a copybook and to practice a bit more of my handwriting. Alright, so let's put this one as the first scenario. It's a principal plus interest repayment. Loan amount at 1 mil. Interest rate is 3%. And it's a 30 years long term. So we'll get and it's a monthly repayment. So with that, it gets to 360 repayment. We've got a total interest here. You add that up with the original loan amount, we'll have the total cost of the loan, which is principal plus interest. And you divide it into 360 repayment. You get a monthly repayment here, $4,216.04. Alright, how do they calculate total interest? Let's get into the repayment table. The first interest is very easy. Alright, the first repayment. Remaining balance is 1 mil. Remember, the interest rate is 3%. So we can calculate 3% interest rate per annum, you get the rate, and then you divide into 12 months. You get the interest is 2,500. Then we need to add principal because it's a P&I product. So after you add the principal, we already know this is the repayment, right? This repayment, 2,500, goes into the interest, and the rest will go to the principal. So now you have a look. The beginning balance minus the interest, the principal has been paid. We have an ending balance of the first repayment, and the ending balance of the first repayment, it equals to the beginning balance of the second repayment. So you can see the principal that we are paying is getting larger and larger because more principal goes into the balance. That means the ending balance is getting smaller and smaller. And of course, the interest that you'll be paying will also getting smaller and smaller. So from the first repayment, we goes to the last final repayment, which is 30 years later when we all become granny. Alright, 30 years later, the last repayment always remains the same. That's a minimum charge. Assume the interest rate doesn't change, okay? If the interest rate goes up, your repayment will be higher. If the interest rate goes down, we'll get to there later. Alright, so with this repayment, you'll find the last repayment is over 4,200 goes into the principal, and only $10, around $10 goes to interest. And finally, we pay for all the loan. The outstanding is clear now. Alright, so this is the basic concept of the repayment. Now we can start with fixed term loan. Alright, with fixed term loan, most of the lender, they have 1 to 5 years for you to pick. Within this 1 to 5 years time, the long term, let's say we fix it for 2 years. It doesn't matter if the rate goes up or goes down. Your interest rate will always remain the same. Let's say it's 3%. Within this 2 years time, it doesn't matter the rate goes up or down. Your interest rate remain at 3%. Okay, so how about this fixed term finish? What's gonna happen? The whole loan is 30 years. And we fix for the first 2 years at 3%. Okay, from the 3rd year onward, if you don't do anything, it will jump to variable without you doing anything. So at that time, you have 2 options. The first one is like, you know, just let it be and let's get to variable. The second one, you can ring up your banker or your broker and ask them how much is the fixed rate at that time. So you can consider fix it again or leave it as variable. All right, with the repayment. That was the repayment that we're supposed to pay and was based on 3%. Let's say when you redo your loan, it doesn't matter fixed or variable, the interest rate go up to 3.1%. In this case, your repayment may be, let's say, just make it easy, 4,300 is the repayment, then they will charge 4,300 for your repayment. But if was 3% and then when you refix it again or leave it as variable, the rate drop, it becomes 2.9%. So what happened is they will still charge you this repayment. They will charge the higher repayment unless you call the bank and goes like, look, just charge me whatever is the market rate, and they will drop it. Let's say that's 4,200, and then the repayment will change. Otherwise, they will always charge on the higher repayment. But for whatever you pay extra, let's make it 4,000 ACR. So you have extra $216.04. Extra you pay. It doesn't matter that you pay extra because this one go back to the principal. If it goes back to the principal, it also means that you shorten your whole long term. You know, you pay more on the principal, you don't need 30 years. Your loan will be finished, you know. So it doesn't matter unless you're very tight with money. Otherwise, just leave it as is. Alright, so now we get to another one. How if you break the fixed term? Let's say this one is owner occupied, principal plus interest, fixed for 2 years. We make it fixed for 5 years. Alright, within the fixed term, 5 years. You finish the 3rd year. At that time, outstanding is 950K. And 3 years here, 2 years here. Now you want to break it. It doesn't matter whatever reason, you know, you refinance or you just want to get a better rate or you prefer variable because you got extra fund. At that time, there will be 3 different scenarios will come out. The first one, let's assume we fix it for 5 years and it's 3%. So the first one is your fixed term, when you break it, it still remain at 3%. The second one is the rate go up to 3.1%. The third one is the rate it dropped to 2.9%. So what will happen? The concept is very easy to understand. If you break the fixed term, 3%, the lender take your 3% and lend it to someone else at 3%. They're not making any money, but they're not losing any money. So there's no penalty when you break the fixed term. The second one, the lender take your 3%, they lend it to someone else at 3.1%. Same product. Remember, it has to be completely same product. That means they're making extra 0.1%. They make extra money, you have no penalty. So the last one, now you understand. If it's 3% and when you break it, it's 2.9%, that means the bank, they're making less money because you break it. In this case, you will have penalty. So the penalty, how do they calculate it? It's the remaining loan balance times the remaining loan fixed term times whatever they make less, which is 0.1%. And that will be the penalty. So that means actually, you know, every day you call, they will give you a different number because the principal that you own will be different. So you can only call them and find out what is the latest penalty if there's any break clause. Alright, also with fixed term, there will be no offset account attached. Well, let me make it clear. Some lender, they will have an offset account, but it's not 100% offset. They might offset for certain amount only, not the full offset account. The other one is with fixed term. It doesn't have offset account, but it allows you to make extra repayment. So this one, because what happened is different lender, they have different policy. Some of them, let's say we fix for 2 years. Some of them is like you can pay 5 grand extra per year. Some is like 10 grand extra per year. Some is like 20 grand extra per fixed term. So per fixed term, it means like if you fix for 2 years, if within 2 years you can only pay 20 grand extra. If you fix for 5 years, that means within these 5 years, you can only pay extra 20,000. So does that make sense? All right, so now we get to verbal loan. Actually, with verbal, there's 2 different types of verbal loan. The first one is the one that we always heard of, with offset account. It's called standard verbal. And then the other type of verbal is called basic verbal. So we'll explain that later. Let's start with standard verbal with offset account. If you open your online banking, what you can see is loan amount, let's say it's 1 million. And then it attached with a transaction account. This transaction account, it can be any like saving account, your normal daily transfer account, and it adds offset feature to it and link to the loan. Then it becomes an offset account. So let's say I've got 100,000 in my offset account. So you can see 1 million loan amount minus the offset 1 million. You're actually owing the bank 900,000. So the interest you'll be paying is based on 900,000. Let's say this is still the repayment that you have to pay monthly. That's based on 1 mil. But actually, because you've got money in your offset account, you're paying less on interest, and whatever extra that you're not going into interest, it goes to the principal. That also means you shorten your long term. Let me put another scenario. It'll be more clear. Let's say the loan is 1 million, and I have 1 million in my offset account. So actually, I'm owing $0. That means the full repayment, it goes all into the principal. So if you want to calculate, it's very easy. 1 million divided by the repayment, you have how many repayment you have to make. You don't need that loan. You don't need that loan because there's no interest. Much less than 360 repayment, then the whole loan will be finished because everything goes into the principal. All right, now let's get into basic variable. It's not too complicated. So basic variable, you still see the loan amount at 1 million. And there will be a transaction account. This one is not offset account. Basic variable does not have offset account. So I still have 100 grand in my transaction account. How do I use it like an offset? What you have to do is you have to transfer this 100,000 into the loan account. So that means it will become 900,000. You transfer into it. and here gets to 0. So the interest that you'll be paying will be based on 900,000. It doesn't have offset account. So this is how the basic variable is like. And further detail with basic variable and standard variable. First of all, annual fee. Most of the basic variable loan, it does not have annual fee. With standard variable, most of the lender charge $250 to $395 per annum. So settlement fee. Basic variable, most of them, they will have settlement fee. Not all of them, but most of them. Standard variable, it will have $0 to a cheaper amount of settlement fee. This cheaper amount is compared to basic variable. And valuation. Some of the basic variable, it does not charge valuation fee, but some of them they do. With standard variable, most of them there's no valuation fee. And offset account. Basic variable does not have offset account. Standard variable, there's offset account. Account fee, or we call it transaction fee. Basic variable, most of them, they will have account fee. Standard variable, most of them, they don't have any account fee. Also, with basic variable, some of them, they have a limit of how many transactions you can do. You know, like daily transaction, monthly transaction. If you go over that, they will charge you a fee for that. So now you have the basic concept of fixed term, variable. It gets to how do we set up a proper speed of a loan. So we got 3 different types. The first one, very easy, is fixed. So you fix the whole amount, or you leave the whole thing as variable. Or the third one is you combine them together. We call it speed loan. You have part of it fixed and part of it variable. So how do we do it, and what is the benefit of it? First of all, let's say fixed term is 3%. Variable, most of them is like 0.3 to 0.5% higher than fixed term loan. We use 0.3, let's say 3.3%. It has offset account. And at that time, I've got 200,000 saving plus, let's say we fixed the fixed term for 2 years. Plus in the future 2 years, I can see I'm going to save up another 100,000. So I have in total of 300,000. That can go into the offset account and save me some interest. The loan amount is 1 million. So the way I set it up is I'll fix it 700,000 at fixed term. The other 300,000, I leave it as variable attached with offset account. So you know, even this one, the interest rate is higher, but because I got money in the offset account, it ends up I might not be paying much interest, you know. But of course, you got to think about another thing is like if the rate is going to go up or go down. There's no way you can always fix it at the cheapest interest rate, because if you keep comparing the interest rate, you find you're going to get upset all the time. Today you fix it at 3%, and then you look at another small lender or other one, it'll always be something cheaper. You know, you see 3%, you think it's the cheapest, and then after that another lender come out, they say 2.9. But you already fixed it. You're just going to upset yourself. The proper way to do it is actually, you know, you set up a speed, a repayment that you can afford, a speed which is suitable for you the most, you know, and that is enough. So now you've got the basic concept of fixed and variable. In the future, when you structure your loan, you know what to do, how to put them. If you've got any question, you can always contact me or WhatsApp me. During business hour, I don't always pick up the phone because I'm pretty busy. If you WhatsApp me and I don't respond or reply your phone call within 1 to 2 business days, you can just keep calling or texting. Alright, so this is my contact number, 0420-828-828. My name is Rachel. I'll see you in the next video. Thank you, bye-bye.